Techlash, one of the Financial Times' 2018 words of the year. It means the growing animosity towards tech giants in Silicon Valley. So will the stumbling blocks persist into 2019 for big tech? With me now to discuss is Dan Ives, Head of Tech Research at Wedbush. Dan, thanks so much for joining us. So what have you made of the struggles in the US tech sector this year? Did it catch you off guard?
I think it got a lot of investors off guard. Just, I think, the degree of softness we've seen in the stocks, and I think part of it has been a 1-2 punch, right? I mean, China continues to kind of be that sort of black cloud over tech stocks, but you've seen a re-rating lower, and a lot of the darling names like an Apple and Amazon really across the board have sort of led the decline, and I think especially when you look at a lot of the high flyer names, I mean, a lot of these stocks are around 30-40% going into year end. I think the fundamental concerns are overdone, but I think the degree and how quickly we've seen the sort of sell-off has definitely caught investors flat-footed.
Do you think that the pain for the FANGs continues into next year?
I think you have to almost separate them in terms of, the specific issues on each. I mean, obviously data privacy and advertising concerns for the consumer players. I think when you look at Apple in particular, I mean, that's really the one that's going to have the most pronounced impact in the broader tech space. Because that's the whole food chain, that's semiconductors. I mean, right now, semiconductor stocks almost feel diseased. And I think when you look at Apple, it all comes down to iPhone units stabilizing in terms of supply demand, no disruptions out of China. I think at this point, sentiment really on the street thinks that there's another kind of 5-10% iPhone cut coming. I think if you don't see that, Apple stabilize as well as the broader chip sector, which has really been an overhang in the tech space.
All right, well, let's have a quick look at the shares of Apple, because we can see from the chart the very, very sharp declines here since sort of the highs back in October. I think it's on pace for its fourth month of losses. I mean, do these losses continue as we head into the new year, or is this a good time to go bargain hunting?
Yeah, I mean, look, I think we could still see some maybe more softness on the downside. Call it 3 to 5%, but ultimately, I mean, we think this is a stock that, we'll have a 2 in front of it as at one point as we get in 2019. I view this as a name, let's call it, maybe $5, $10 downside, call it $40, $50, $60 upside. But it comes down to, an iPhone cycle that starts to stabilize, and ultimately, I think it's about Apple needing to do price cuts, especially in China, because 10R, that's really been the softness in China. And I think right now, it's all about the January when they report earnings as sort of what could be an inflection point for Apple.
Let's move on to Facebook now, because it announced its plans for a share buyback recently, and the news obviously welcomed by investors who have been punished by the cloud issue around Cambridge Analytica and, of course, those blurred lines into politics. So what should we be watching out for when it comes to this stock into next year?
Look, I think across the board, I mean, for a lot of these tech players, it's regulatory, as well as a lot of it's about user metrics and monetization. I think what you're starting to see on a lot of these FANG names, you got to separate between the consumer and the enterprise plays. And I think on the consumer plays, look, there's a lot of concerns specifically from regulatory, and I think what you're really seeing here is that a lot of the names that were the darlings, these are names that right now are viewed as toxic. And I think the FANG names as a group, which really led the tech rally, I think now you're continuing to see sort of softness. And I think what's also happening here is that you're having a rotation to more of the stable names, call it like a Microsoft. And I can tell you on large cap, I see a lot of large cap tech money moving from FANG names to a name like Microsoft.
Well, I really wanted to ask you about Microsoft, because it's been a real interesting stock this year, a real dark horse in the tech race. It's been outperforming the FANGs, making good strides in the cloud business. So are you optimistic there?
Yeah, I mean, look, I think in our opinion, Microsoft and large cap is probably one of the best ways to play the cloud trend in 2019. You look at what Nadella and Microsoft have done, on cloud. Obviously, you have AWS and Azure, but really Microsoft here, they've transformed the company into a cloud behemoth. You've seen the multiple move up, but you've seen growth rates now. I mean, double-digit growth for a company of this size. And in our opinion, they're still only in the first, second inning of this cloud story playing out from Microsoft. And I think as 2019 comes, this is a stock that could approach $1 trillion market cap. And I think you're starting to see that kind of stable up and to the right sort of earnings that Microsoft's produced now be a favor among tech investors that have really moved away from FANG names into names like Microsoft.
Now, I also wanted to have a quick look at the chart of Tesla because that's been an unexpected outperformer this year. We can see the share price performance there significantly better than the likes of Apple or Facebook. Will that continue in 2019?
We believe it does. And then a lot of that's really about Model 3 production, turn the corner in terms of some of the bottlenecks we saw coming out of Giga and specifically Fremont. You know, I think you put the math behind them, and this is a company, they turned a significant profit in 3Q. I think same type trend 4Q, especially right now you go in 2019. I do not believe a capital raise on the horizon. And I think with production and more full capacity, I think right now Musk and Tesla really start to see Model 3. We believe you could see 300K units delivered in 2019. So I think this is a name more investors are viewing as a disruptive tech play. Given the profitability, there's noise there, but I think there's a stock that, ultimately, in our opinion, continues to go higher.
Now let's have a quick look at Netflix as well, because it seems that there are quite strong arguments in both the bull and bear case, particularly with the likes of Disney entering the competition. Where do you just stand on that debate?
It's getting more crowded in streaming, and I think it's not just Disney and obviously consolidation you've seen. There's worries that Apple in particular could be more aggressive on the streaming side, and I think it's all about content, right? But if you look to metrics have changed from an investor perspective, and now investors are focused on profitability, what the trajectory looks like. You look competition, and with Iger and Disney coming in, it's made for a much more crowded space. And I think the wild card's Apple. You know, how aggressive they get on streaming. I think that's one that could significantly disrupt the industry.
So is Netflix still a buy for you?
Look, I mean, our opinion on when I look at large cap tech, I'd much rather be owning an Apple and a Microsoft here than some of those other names.
So are those your two top sector picks?
Yeah, I mean, I look at Microsoft and Apple as two top sector picks. Then from a disruptive technology, you look at large cap, you look at a name like Tesla. And then you focus on also some of these areas in cybersecurity, Palo Alto, Zscaler, Qualys. That's a secular theme that we like to play in terms of cybersecurity.
Dan, thanks so much for your time.
Thank you.
That was Dan Ives, Head of Tech Research at Wedbush. I'm Victoria Scholar. Thank you for joining us on IGTV, and we'll see you very soon.